I'm Joanne Poe from CoinDesk, and I'm a journalist. So when I see a headline or a title, Inflection Point, will 2020 be the year digital assets join the mainstream? In the journalism world, it's an automatic no, okay? But that's what we're here to debate. And I am joined by an esteemed panel, Richard Byworth, who's the CEO of Diginex, Neha Narula, Director of the Digital Currency Initiative at MIT Media Lab, Michael Chlipala of the London Stock Exchange Group, where he's Senior Manager of FinTech Business and Technology Strategy, Jason Chlipala, COO of the Stellar Development Foundation, and John Werner, Managing Director of Link Ventures. Welcome. I want to start off, yeah, it is an all-star panel, right? I want to start off by asking a question, and any one of you guys can actually pick this up and add to it. What do you see as the unique attributes of digital assets versus traditional assets?
I can go. Or do you?
Go ahead.
Yeah. So coming from the financial market infrastructure business, which is the London Stock Exchange Group. So the way we look at it is, what does it practically enable? So again, we're focused on assets that are backed by something, right? They have a legal structure. Of course, we have the crypto side of things, but so what does it enable? What does it do? So I think we look at blockchain and digital assets as essentially in a market structure that has multiple parties that you will not be able to get rid of because you're creating systemically important finance. It creates a simulated vertical integration, right? So it's as if we brought together the custodian banks, all the market participants, the CSD, the exchange into a single point of access where you can programmatically access assets, right? That's what we really want to achieve out of this. So we talk about disintermediation. I think it's how do we not disintermediate what needs to be kept, yet still achieve the same benefits? And this is speaking again in the non-crypto space.
I'd take a slightly different tilt. I think the angling of the question ends up with an implication, an inference that you end up making that is that digital securities are somehow different to traditional securities. And I think that if we're talking about these assets joining the mainstream, I think that narrative is wrong. And I think, one of the projects that we've worked on recently, we've said, okay, we want to issue a security and we want to go to traditional investors in this security and go to them and give them the option to flip into a digital security at some point in time. Because if we're talking about this joining the mainstream, we need real investors, proper institutional allocators of capital to start to address this as a real asset class. And I think by trying to suggest that there's a difference between what these securities are is problematic. It's really just the way that these are transmitted and moved around. It's the delivery method. So, what you go and you say to a pension fund, you say, would you like to be investing in this digital asset? The answer is immediately going to be no, because they have to take it to risk committee. They have to try and explain what a digital security is. They have to explain what Ethereum is, what an ERC 1400 standard is, how do you custody that? It's just fraught with problems and it's too hard. And so when you say, we can issue a security that's interesting for you, and at some point in time you can flip that into a digital security and get to the point of understanding what it looks like, then I think that's probably the right way to be addressing it.
Oh, I'd just add one quick thing to it. I think the difference, and maybe you were saying this in how it's transmitted, is the API, really. It's about giving an API, a programmatic interface to assets, an open programmatic interface to assets, so we can write software against them. And who knows what that might enable? That could enable a lot of different things. It can enable custodians that don't control your assets but only have a small key share part of them. It can enable complex contracts. It can enable different types of exchange. So that's how I'd summarize it.
100% agree.
I'm sorry?
Coming from a former And I just wanted to say two things. One, I think it's really cool that Michael from an exchange is saying this. I mean, if I say, like, I work at a blockchain, so of course I'm going to say interoperability is amazing, but I think it's really cool that even you're saying that, so that's amazing. And the way I think about this interoperability argument. I think for years, I think the whole blockchain compared to the internet comparison is so overblown. People saying, blockchain's like the internet in the 90s. In my opinion, the internet was about information. It's about something much more general, much more fundamental. So I don't like that overblown comparison. However, it's still an excellent model of like what Neha was saying of what can happen when you have APIs and when you can interoperate. So I think it's absolutely the right model to think about when things can interact easily, who knows what will happen. So that's how I think of it.
So just on that point, I mean, the web 50 years ago, or the ARPANET got started 50 years ago, the web in the 90s, when they got started, you didn't really know what was going to happen with them. I do think we're so early here that blockchain can really change the relationship with a lot of trusted institutions and be for good, and like Uber didn't come around until much later, and in 2014 I think there were 90 funds, now there are 900 funds where people are doing things. So I think we're at a Wild West interesting time, and there's been a lot of Shakespearean dramas going on.
Well, digital assets have grown into a over $200 billion industry, but institutional players have kind of been on the sidelines. How do we get them off the sidelines?
So can I?
Sure.
So again, so let's I always make the distinction. Let's talk about, so broadly, it's the digital assets with no central operator, cryptocurrencies, right, and digital assets with a central operator, security, tokens, stable coins, this sort of thing. So when we talk about the sidelines, there's two broad distinctions I would make. So on the cryptocurrency side, right, the real focus today, and I think again going back to where we've advanced from, the real focus today is. Of course, it's the infrastructure that banks need to hold and custody these assets. But the other part, and there's been a lot of clarification here around anti-money laundering, know your client. So a lot of regulatory clarification has been provided. However, right, what's still keeping institutions off the sidelines on the crypto assets that are cryptocurrencies is the prudential treatment, so the risk treatment, right? So how do I handle my exposure of holding these assets, right? So it's not very clear, right? When we flip over to the security side and institutional adoption of blockchain, the question actually is less about that, because if you have a central operator, remember in finance, let's flip this on its head a little bit. What do we do in finance? Like, what are we actually doing? Everyone talks about paper-based. No. We have legal structures, and we create automated systems to basically transactionalize these legal structures. Central bank money, commercial bank money, securities, right? They're all legal structures, right? And that's why they have value. So I think, on the institutional fundamental for crypto is more on the prudential risk treatment side, less on the KYC, now that we have the FATF report, the fifth anti-money laundering directive in Europe. And then on the institutional side, it's more of like, I think it needs to be led by financial market infrastructure and to build like the value proposition, which is what we're working on. So it's a little bit of a different play.
Can I say something a little bit controversial? I
Sure.
think that behind this whole when are the institutions going to come in? When are the institutions coming? Is basically this desire to see mainstream sort of recognition and pump the price of people's tokens. I think that's what's going on here. They want the institutions to come in and start buying tokens. They want the price of Bitcoin to go back up to $20,000 and beyond. And whatever you want to say about speculation and these digital assets, there's also some very cool technology here that can enable some real use cases. So when will the institutions come? When we're doing things that are useful and they need it. That's when they'll come.
Yeah, I think I'd add to Neha's point. I think if you're looking at it from a virtual currency perspective, then obviously it needs to be something that's interesting to institutions, but it also needs to have infrastructure that allows for that. And obviously what Michael and the team are doing at the London Stock Exchange is fantastic, because it allows that first step of an institutional exchange to start to participate. The other issue will always be custody, and having regulated custody for this asset class, as well as certified on a cybersecurity level, as well as actually having a base of assets and insurance around that, I think is particularly interesting in the way that we're going to see more institutional adoption.
And Richard, your company, Diginex, talks to a lot of institutional players, and I mean, what are they most worried about? What's holding them back?
It's one thing, it's reputational risk. when you talk to an asset manager that's dealing with trillions of dollars of assets under management, and you say, hey, you could participate in this asset class, and maybe you can look at 800 funds and select the 10 that are doing things the right way and start to invest. You can probably allocate $100 million. A, that's not particularly interesting enough for them to start to actually allocate. But B, they don't want to do anything that's going to cause them to lose $500 billion of assets, from having some stupid situation with a hack or something like that, or investing in something that has been tainted with terrorist financing or something like this. So the reputational concern is always the main issue.
Does that mean establishing a bigger supply of trusted custodians? You keep talking about the custodian.
Yeah, look, I think when we start to see more and more, and obviously Fidelity Digital Assets have launched, we've launched, and we're heading into the FCA sandbox. We've been certified by the Cyber Essentials Group, which is a Ministry of Defense designed cybersecurity certification. We just need more and more of this to come to give people options. I mean, we talk to clients across Asia, and when we tell them that we're a custodian operating out of London, they're like, "Oh, this is fantastic," because my only choices were in the US, right? You got backed Fidelity, all these guys with custodian solutions. They actually want something that's outside of the US.
I think at some point, this technology will be seen as get a utility fund. It'll be like oxygen. Can't afford not to do it. I think a lot of people are getting involved for FOMO, fear of missing out. I have kids that hear that a lot. I also noticed that we've been talking for a while and no one's mentioned Libra. So also, sorry. But I also think they're in Andreessen Horowitz, 6%. There's some players that are also changing. There's a Jupiter kind of creating some gravity pulls, and it'll be interesting to see what happens next 12 months.
Yeah, just to throw in the Libra, just to back up the Libra point again, because we've worked as London Stock Exchange Group, right? We're involved with the EU Commission, with the UK regulators, even the SEC in the US. Look, so Libra, basically, what happened was policymakers were like, well, this crypto assets, so cryptocurrencies, and then the security token side of things, niche space, not systemically important enough yet for us to actually do any real work other than some kind of like PR type exercises in some niche markets, right, that are not usually outside of the G20. Once Libra came in, 2 billion, you've got a community of 2 billion. Before you were dealing in kind of boring aspects of people's social lives and dog pictures, and then all of a sudden you move into a vertical, banking. I mean, now it's stable coins, but it's banking, right? And that has real potential, right? So all of these bodies, like the Bank of International Settlement, the Basel Committee, right, on payments, dusted off all these white papers that they had, right, not in the public sphere, and started kind of progressing things. So I think actually, big tech, well, Libra likes to say it's independent, but big tech moving into the space at the scale that it's doing has already advanced the analysis, in the last 6 months, right, massively, or at least made that public. So I think actually we are at the tipping point of clarity in analysis.
I want to move on to regulation. We talked about risk, but is that the biggest kind of elephant in the room in terms of what's holding people back?
I think regulation is one of the biggest issues because we're starting to see regulators trying to regulate this space. Some of them are doing it the right way. Others are sort of tripping over themselves and actually inhibiting innovation altogether. I think some good regulators, not to speak negatively about anyone, maybe the good regulators. I think Switzerland have done great work in trying to define this whole asset class, differentiate between tokens and define regulation around that. I think Singapore actually are providing very innovative approach to it and really being very open, a complete contrarian to the way that Hong Kong have approached it, which we're seeing as being really quite destructive of innovation across Hong Kong. But yes, coming back to that reputational side, if you can say we're a regulated firm versus a non-regulated firm, I think immediately that reputational risk that the institutions have is diminished.
And I just want to say, at Stellar, we certainly agree with that point. We definitely think of all of this is to enhance the financial system, not subvert it. we're not looking to create this kind of parallel shadow financial system. So on Stellar in particular, there's a huge focus on getting regulated financial institutions using Stellar. And like a great example of this is Franklin Templeton announced they're going to be issuing a money market fund and going to be using Stellar to track ownership of it. And that was a case of, we first learned about that when they filed with the SEC. So even though regulation can be slow, there's kind of like the right ways to do it. Talking to regulators, there aren't always clear answers, but there does feel like there's this shift where they do actually want to help now. They're not trying to just say no because they don't want to lose their job by saying yes. They actually are trying to help. So you can work with the regulators and kind of do it in a smart way.
And let me just add one thing. So from our perspective, right? So I think actually, while moving maybe a little bit slower than some of the progressive jurisdictions, Europe and even the UK, right, have the generally right approach. So the approach to regulation essentially is this activities-based approach. So it says, what are you doing? Same activity, same proportionate risk, same rule. So regulation should never be tech-specific. It's tech-neutral, right? And to the extent that we can be sufficiently abstract, right, in our regulation, you should be able to implement in technology whatever you want, the principles of regulation, like however you want that to look, right? So long as you uphold the principles. Now, there are, we do meet some challenges there, right? So I think some of the challenges specifically were on the cryptocurrency space, but in the blockchain and security space, the issue wasn't really about it was too prescriptive and you couldn't use blockchain. That was never the issue. The issue really was that think about I'll use central banks as the example, but then we can take it to securities. Central banks, right, exist because the only way to ensure control of something systemically important, like from a technology implementation perspective, is to centralize it, right? We built centralized systems for this. The same happens in securities. They're called central securities depositories. And actually with blockchain, right, so it's not really that we couldn't use blockchain as a central bank or a central securities depository, but the question is, can I have the same protections and have the same, ensure the kind of, the same fundamental systemic protections by slightly decentralizing or unbundling these centralized entities. And that was where the hurdle was. It wasn't that the technology couldn't be used, right, today. And in fact, the activities-based approach made that clear, but the structural requirement did.
Yeah, I think also the new technology introduces new systemic risks, unfortunately, and the regulators really are still trying to get a handle on this, in part because the technologists are still trying to get a handle on this. So, with blockchain-based technology, you've got bugs in the code. How easy is it to actually fix these bugs and deploy that in a decentralized system? Who really has control? You have 20 validators. What does that actually mean? Who has power here? And so I think, from a regulatory perspective, there's just so much to figure out about what are the new risks that could be introduced here as well. But I do agree with you that it shouldn't be technology prescriptive, but it should keep in mind the risks of the technology.
Aren't public markets fairly transparent now? I mean, relatively transparent. So what's so special about transparency led by blockchain?
First, well, so there's two sides. So so we've got the asset, because I always hear this, but I'm sure people in the room understand, right? You always hear, digitized instruments, they'll become liquid. I'm like, what? Like, there's the asset and then there's the market, right? Two different things. So transparency to me is, that's all about markets. So so when you're creating new types of assets, you have the same kind of considerations, and I think I've said it before, like information symmetry. So if I'm trading with somebody, right, I want to know that I can receive the information at the same time, right? There's no insider dealing, and this is something that has to scale, right? To create a fair and orderly market that protects investors, then you've got to play by the same rules. Of course, in today's world, there is insider dealing, right? I mean, Martha Stewart, but I mean, there's tons of other stuff that goes unprosecuted. So I think, today's markets, right? They're well understood. They are transparent. I don't know, right, if blockchain really introduces any forces that would improve that. I think it kind of sits separately.
Maybe I can just take a slightly different tilt. I think we have a capital markets business, and everything that we are doing on the advisory side is around non-transparent industries. So it's private equity and it's real estate. And so if you think, generally where you see, let's take an example. So let's say you're an investor in KKR's infrastructure fund, and you have that with your private bank, UBS, and you say, actually, I didn't want a 7-year lockup. I want to go and sell it. And so the private bank goes to some secondary market provider that has an understanding of what's in the portfolio. But because they're the only people with the information, they actually can bid down quite significantly because they know that you need the liquidity. They're one of the only providers of that liquidity. And so you end up trading at like a 50% discount sometimes to the last NAV. So what blockchain enables you to do, once you combine a security with this open data, open information, what you can start to do is embed documentation into a security itself. And so then what you can do is you can have effectively a security that runs with a virtual data room that you can, as an investor, you can have on an exchange, and it can be any regulated exchange. Maybe the London Stock Exchange can do this as well with their digital board. You can effectively click on the KKR infrastructure fund, see that there's a seller out there, look at the portfolio, look at the recent investments, and actually have that information to be able to make an educated decision. And so obviously from a private equity and real estate perspective, you start to reduce that discount to the NAV.
And I'd say in addition to that, another area where you could see increased transparency is payments. And so I think probably most people, when they hear digital assets, they do think more the capital markets use case, but there's also the payments use case, so it's more transparent in the sense of you could see exactly what's happening in a payment instead of having to trace some complex sequence of correspondent banks. And what's also interesting, and this gets back to the API interoperability point, at a certain point, digital assets and payments start to mingle because if these digital assets can be moved around easily and people can use them, you can start to pay for things with them. So then they start to really move into the realm of payments. So I definitely think there's increased transparency there.
John, what do you think will be the most important contributor for a robust market for digital assets?
I was looking to see if there's another John. So in our Monday meetings at our venture firm, we look at deals, and we do look at a number of deals that are involved with fintech. We're going to this year probably write 14 $3 to $8 million checks. We're not specifically looking for blockchain deals, but we are seeing a lot of deals that are fintech. And we have data, we're very differentiated, we use the data to kind of see what we think is hot. And I think watching what the fintech world does, when I started who's on this panel, I felt kind of like an imposter and a fraud and shouldn't be here. I'm an advisor to a venture fund. Ian, he's a tall guy sitting down there. He's doing a lot of, if you want money, doing a lot of deals in the space. But instead of starting with blockchain, I think it's really interesting to see what's going on in the fintech space and work there. And if you look at venture, I think they were left out of the party in the early, when it got started. They missed a lot of the ICOs. And I think this next chapter, I think venture is going to get in, and I think Andreessen is showing, showing some leadership here, and they're in a position to do that. Did I answer that satisfyingly?
Sort of. Sort of. Others could weigh in, and what do you think is the most important contributor for a robust digital assets market?
I actually do think we can use the word stablecoins. I actually do think having robust, reliable, fiat instruments, for lack of a better term, stablecoins, ways to pay for this stuff, I think that's going to be really important. And I think just sequentially, that will most likely come before a huge digital asset market. I think it's an important component of it.
It's interesting because when I hear the word digital assets, right, it's just so broad, right? But in reality, it involves cryptocurrencies, stablecoins, soon CBDCs, right? So how do you see all of these systems, I guess, coexisting? And how does that factor into how you guys, when you guys talk to clients or when you talk to governments, how you sell that point?
I think there's a huge concern about fragmentation. A lot of people are building their own networks. People are writing their own standards, their own protocols, and it's just not really clear yet exactly how everything is going to shake out. Also, it doesn't make sense to issue everything on one platform. That's a tremendous amount of concentration and risk, and it just doesn't work. So, I know people are definitely thinking about how do we get together, how do we make sure that we do something that is interoperable. I think each constituency is going to have these discussions. The central banks will have to have discussions about cross-border payments, and exchanges will have to have discussions, custodians, and whatnot.
Do you think we're still in a period of experimentation? And if so, how do we actually get a roadmap together?
So quickly on the point of experimentation. So it depends what we're talking about. Again, I actually think, in a lot of ways, right. And the best part about the fact that we had that cryptocurrency, again, ICO. Just quickly, ICOs were successful because they could be, because all of a sudden you had a means outside of a banking system to raise capital. Now, like regardless of the merits of that or how how that was or wasn't fraudulent or real is a separate discussion, but it was a good experimentation. On the cryptocurrency side, I think we're obviously beyond experimentation. I think we very well understand the risks associated with cryptocurrency. We have marketplaces, we can transact with it. When we get into the asset-backed side of things, right? So when we're talking about the scalable finance, and this is where we go back into this interoperability and fragmentation thing. I think we are a little bit experimental with clarity. So in other words, I do think that look, critical mass will gather for scalable finance will gather around decentralized entities, central banks and central securities depositories for legally backed tokens. And this will enable, and I think we won't actually have fragmentation. What we'll have is, once we have these centralized entities that are creating this infrastructure, and we have programmatic access to value, right, and we have programmatic access to data, we will see that platforms will come in and fill the void or bridge the gap, right? So, in banking, we see platforms as kind of emerging as the kind of growing standard, if you will, because we've essentially enabled API access to banking. Now, securities are a lot more complicated, but it's coming, right? So I think platforms will bridge the gap. The centralized entities, such as central securities depositories and central banks, will sort out those standards, and I'm positive.
I don't think we're still in a time of experimentation. I was here in the lounge about an hour and a half ago. I was talking to someone who, I think this is his third Davos in a row, and he was saying 2 years ago, if you said blockchain, people would be like, "Oh yeah, let's talk about that." Like, I want to do this, this, and this, and they were so excited and like feverish about it. And he was saying now, you mentioned blockchain, they're like, okay. And I think that's actually really good. I think that means there's a lot more signal now, and now people don't want to experiment. They want to actually do something. And that necessarily means that fewer people are interested, which is good, because a lot of them they didn't have real projects. So I don't think it's experimentation. There's still things to be figured out, but I think people actually want to build useful, real things now.
I would say slightly contrarian to that point is that we are in an experimental phase in terms of deciding which blockchain that potentially you can be using to issue securities. We position ourselves as being protocol agnostic for that very reason, because we're sure that we're going to start to see evolution in this space, and as we start to see more and more security issuance. I think just coming back to a robust sort of industry, I think all of us have to take responsibility to just actually walk people gently into this new asset class, because to walk them up to the side of the cliff and say, hey, let's go, it's digital assets, these are amazing things, they can do all sorts of clever things and move around really fast, that's just not going to happen. And so what we need to do is, it's a hold-handing exercise, it's walking them down gently, getting them into it, and like I said before, maybe working with a paper security and having a way that we can transition that into a digital security eventually.
At the end of the day, it's trying to convince my aunt and my mother that these assets, when they hear the word digital assets and their eyes glaze over or they get scared. I usually get two reactions, right? So, for the people outside of this room, give me some talking points on how I take it out there and convince folks that this
Yeah.
is real.
Well, I would actually start with open question whether your aunt or others even need to know about digital assets versus not digital. Like, as Richard was saying, the asset is still the same. Like, it drives me crazy when people talk about digitizing real estate. What does that mean? It's a physical thing. So for probably most people, I don't know that you have to make the argument. So I'm going to answer the question by not answering the question. That was easy.
Yeah, I again, like going back to like why are we using this technology? What does it enable? Blah blah blah. Again, so crypto assets being the whole categorization, cryptocurrencies on one side, and then legal structures that are represented on blockchain being the other side of things. Yeah, it's the question of like when we're building value and building new solutions and building new infrastructure for digital assets or crypto assets. From a user's perspective, it's what does it enable? What does it do better? What does it do faster? What does it do cheaper? What kind of new products can it create? Right? I don't care, what blockchain you're using. I want to know what it does for me, right? So I think so from the perspective of the user, it's actually that's not the question, right? So the thing is, what's coming down the road feature-wise that would be interesting, right?
Yeah, I would just add to that. I struggle with this as well because oftentimes if you go home for Thanksgiving and you try to explain to your uncle or your grandfather what you do and their eyes glaze over and if you do manage to get through to them, then the next thing they want to do is go buy some crazy token and you're like, no, that's not what I meant, that's not how you should get involved in this space. But that's how the current sort of way of participating is to go on Coinbase or Binance and to do that. So I'm going to echo what I think a few of these others are saying, which is we just still have a long way to go. There's still a lot to build and a lot to figure out before we get to the point where they can really meaningfully engage and see a difference in what they're doing. One thing that I have found very helpful is starting a conversation about our monetary system and what money is and how the banking system works.
That's a good point.
And I found people don't really think about that very much. They don't think about what's backing money and what it really means. And even that can be very illuminating.
You mentioned tokens, Neha. Do you think more consolidation is needed? I mean, we have thousands and thousands of coins out there right now. I mean,
there's different ways to look at this. Certainly there's been theories that, hey, we only really need one currency or coin per use case, and it's gonna aggregate around them. Another way of looking at it is, well, how many actual assets, how many securities do we have in the world? I mean, definitely thousands upon thousands. So let 1,000 flowers bloom. I think there'll be a lot of experimentation.
The movie Highlander, can only be one.
Again, I don't see digital assets as a new asset. Like we talk about crypto assets, some new asset class. Cryptocurrencies are a new asset class, but like everything else, again, is defined by what rights does it confer upon me, right? I mean, it's not, I don't see it as a new asset class. It's a technology enabling something, and then you've got cryptocurrencies, which are just a speculative instrument of transmission of value in a novel way, right?
Yeah, I think coming back to your aunt, that you're trying to get her to buy Bitcoin or buy Bitcoin in a safe way, I think the point that custodianship is no longer a concern, i.e. that security is solved in a warm way, i.e. you've got something on your wallet that you completely trust. You don't have to think about that. It's like the conversation moves away from, is this safe? It's like walking into a car dealership. You buy a car, you go, okay, the salesman says to you, oh, well, the car can get you from A to B. You're like, well, that's not really what I'm interested in. I'm interested in the features of it, the tokenomics, whatever it might be. And so once you're able to progress to that conversation and people are not thinking about how do they actually send this stuff or keep it safe, then I think that's when we actually progress.
For Aunt Ginny, I'm more interested in helping in the health space or education or real estate and unlocking a lot of, making life better than just getting her to buy more coins.
got it. So for the panel, how quickly do you expect the digital asset market to mature? Can you forecast out the next 5 to 10 years for me?
Go. So let's just 5 to 10 years. Again, digital assets, so cryptocurrencies, and then we've got the legally backed something right in the real world. So I think we'll so we'll see, just as we see in banking, right? the API, right, so the programmatic access to asset management will disrupt linear business models, right, and we'll see kind of a shift. So you have the fundamental kind of infrastructure for the transmission of digital assets and value legally. And then you'll have platforms on top, right, accessing data and value, building new types of products. So you'll see this kind of explosion of platforms of assets and data together, right, because we'll be able to access directly asset management. Two, central bank digital currency will definitely be in the G20, right? It'll be there. I think we have a lot more economic questions to ask, and actually it's less about the tech. It's more about like, what is the impact of the fractional reserve lending system on giving everyone a digital wallet and they're not going to deposit in a bank, right? Because you're attaining the same thing. That's a huge thing. Or if I settle instantaneously, what is the economic impact of that, right? Like, it has implications, and those are the kind of questions we're seeing. And then on the security side, I also think we'll see we'll move beyond the traditional asset classes because, as you rightly say, you're going to see data-driven products. So it may be income streams and specific things that are driven by data. Green finance that's driven by information of things, metrics, right, that are feeding into the pricing of a product. So we'll see these kind of new types of combinations of data and value together. So I think in 10 years' time it'll be transformed.
I think taking the question from a security token or digital security aspect, I think we're actually moving a lot faster than we could have ever imagined. So there's infrastructure now that's being built, it's regulated, you've got traditional exchanges moving into this space, you've got custodians coming along, but you're also getting banks starting to issue test case securities, like we've seen it from multiple banks last year, when they're starting to just experiment with the technology that issue a security token or issue leveraging the ledger. So we're actually a lot closer than we think, and I think the focus on central bank currency is actually going to end up focusing much more on the technology, which will end up just pushing everything forward a lot faster.
And banks could end up, well, almost certainly will end up being a key part of CBDCs. It's very, whether the CBDC is only for wholesaling or even if it is retail, but banks, run nodes, et cetera, et cetera. So I think that's also a connection. I couldn't agree more on banks being a really key part of this, commercial banks.
Thank you very much. I want to open it up to questions from the audience. We're going to take questions 3 at a time, just for time efficiency. Any questions?
So we are now listening together. So you guys, you're since Teller, Diginex works with so many public chains. What do you see? The competition there is becoming really fierce. With Ethereum, Algorand, you name it. So what do you see happening in the public blockchain space, infrastructure-wise, 2020?
I mean, it's probably. I do think scalability is going to be really important, both from throughput, but also from electricity consumption. I mean, certainly here at Davos, I think everyone knows climate is a big consideration right now. So I think that'll be a big piece of it.
From our perspective, we don't have our own protocol. We're protocol agnostic. So, coming back to the reputational point, so much is being built on Ethereum that generally moving away from Ethereum is seen as a risk for institutions. That said, we are embarking on a project with Stellar at the moment. We're open to obviously new protocols and always exploring them. But we have to think of our clients as well, and they want to see proof of concept in those blockchains as well.
Hi, Rika Kordayan. Richard, I have a follow-on question to what you were saying earlier about transparency and the ease of transfer of a digitized LP interest in a private fund. Do you see that private funds, they are actually okay with that level of transparency and they're okay about being open, but what's in their portfolio?
Yes, it's a great question. One particular example we have in our pipeline is that they're being forced into this by one of their largest investors. So actually, what ends up happening is it's the investor that drives the process rather than the fund. You're absolutely right. They don't necessarily want this level of transparency. And even if you take it down to the direct company level, does SpaceX want to be revealing everyone who participated in the Series G and the dilution preferences and all of this? So it's an absolutely valid question, which is why we started at the fund level and being driven by their own interest, which is by the LPs eventually.
Thank you.
As we sort out kind of the regulatory puzzle in the U.S., how important do you think that it is that the U.S. gets it solved, or will continued maturity in jurisdictions like the U.K., Singapore, elsewhere, here in Switzerland, allow projects to really definitively move forward and just simply, without having cleaned up, without having a fully cleaned up regulatory picture in the U.S.?
I mean, it depends. Crypto or both crypto and non-crypto, or which side are you?
Well, putting aside Bitcoin, going to crypto assets and more institutional, crypto assets, institutional blockchain can navigate the regulatory environment now. So
Yeah.
the crypto assets.
Yeah, so I think, like the differentiation between the U.S. and the U.S. getting its act together. I think, again, we have to remember, and this goes back to the point about what we're doing here. Like, a lot of the reasons why, you get like capital inbound in a market such as London is because there's a certain group of global investors that don't want exposure to U.S. regulatory issues, right? So they just come to London, they deal with London, no U.S. investors, right? So we just access the rest of the world and leave it aside. So I actually think the U.S. is a dominant financial player. The dollar is backing most things. So I think I think that the current kind of segmentation that we see today will continue to play out. I don't think the U.S. lagging behind, so long as it's not in an antagonistic way. So essentially saying you're illegally offering to American investors, we're going to come after you, we're going to extradite you. So long as it doesn't lead to that, I think the U.S. will continue to progress independently, and I don't think it will actively hold up what's occurring in the UK and other markets. And I think it'll be by example. But where to the extent that the U.S. does lead, right, everyone will copy, right? That generally is how it kind of tends to go. I mean, I'm American, but it does happen a lot, right? That's where the capital is. If the system's working well, we'll try that, right? So long as it's not kind of falling over. So I don't think it's not a constraint, right?
And then I would just want to add, I totally agree that it's not going to hold back. I can think of 3 different companies off the top of my head that are building on Stellar, and one of the key value props for them is this idea that they can start in certain markets, and then from a technical perspective, it's easier to turn on other markets. So they're starting in these other smaller markets, and then U.S., for example, once the regulatory picture becomes clearer, they can then turn that on really quickly. So they don't view it as a problem at all.
I'd also add that the SEC actually has authorized a few broker-dealers to distribute digital securities already. So they're not moving so slowly. And I like, as I kind of intimated before, I like the approach that they're kind of letting it develop and try and work out what it's going to look like before actually imposing regulation that could just stifle innovation. So I actually think that the U.S. approach is correct.
Jason, you said that stablecoins will be very relevant, but having in mind CBDCs, so how stablecoins in relationships with CBDCs will, be alive? What's your?
Yeah, I mean that's a good question. I'm not sure anyone knows for certain. There's certainly a world where if the Fed or the Treasury issues $1, there's not going to be any need for other things. You can also imagine worlds where there still is room for a commercial bank issuing a stable coin. So I think the answer is I don't know. It almost certainly will depend on the specifics of the CBDC. I think some central banks would actively still want other players in that market. They wouldn't want to be the only, but I think it's a little too early to tell. But like Neha was saying, I think it's really cool that people are even thinking about this kind of macro monetary policy question. It's pretty fascinating.
Yeah, if I could add to that, I mean, I think they'll coexist for a while. Different countries are going to issue CBDC in very different ways. There's not going to be one standard. I mean, each country has different goals. They're trying to achieve different things. So I think we're going to see countries do different things. We're going to have a lot of countries sort of sitting back, central banks sitting back and watching to see what happens in Sweden, in South Africa, and wherever it's happening, and then making decisions based on the outputs from that. So during that time period, there's still massive opportunity if they're useful for stablecoins to be created and mature.
I would just add one thing on the interplay between stablecoins and CBDC. If you have an increased proliferation of CBDC, right, and you're looking at stablecoins, and you're looking at like some of the issues raised, around Libra and other stablecoins around redemption, right? So like when I need to actually access the assets legally, right, and redeem, so if there's a run on whatever stablecoin, how do I redeem? If they're backed, if it's kind of if it's a bunch of CBDCs, the redemption becomes a lot easier to understand. So you start addressing some of these scalable issues, and then so you can create baskets and scale, where if you're kind of holding it in some custodial structure and it's in some other country, right, now we're kind of navigating a complex process of redemption, right, if we have a liquidity crisis. So I think actually they will promote, right, stable coins.
I got a question for Michael. As we all know, cryptocurrency exchanges, they're available for private individuals, but traditional exchanges are only available to banks, to their members, right? Now, there are multiple exchanges around the globe that also launch digital exchanges. Now, my question is, will it be the same model, whereas you have to be a member bank to trade on those exchanges, or you think there will be a time when actually we don't need banks anymore to trade security tokens?
Yeah, so that's a complicated. So some markets are direct access. So this is not true. Like China, for example, I thought they have a huge retail and direct access to the market. So it depends on how the nation's structured. But let's just take the example where you have the exchange members and how will blockchain impact that, right? So we have to look at risk, right? So it's really like a lot of this is about risk, right? So when we talk about securities like equities, so like just the tangible assets, most of the risk again was around the settlement, right? So it's kind of like I make a buy or sell order and then have to deliver in 2 days. And it was about controlling the inbound risk and know your client processes. I think actually, that will facilitate the process of market access. But again, we must remember that blockchain, again, it increases competition. So what I think is, right, where banks would have been intermediating access, right, to direct retail, we could see some disruption there. But where you have specific, bank trading desks, right, focused on specific trading strategies, you can't substitute that knowledge, right? The knowledge that you have about hedging, right, around investing. So I think you'll just see essentially increased competition, direct market access, banks just focusing their role more where they differentiate themselves, and that will go for all of the market participants, right? So increased competition, less throw it over the wall, you take care of it model, right?
We've actually looked at the regulation of digital security exchanges in global jurisdictions, and pretty much every regulator that's even thinking about regulating this space at the moment says the only participants you can have in that exchange are going to be broker-dealers or banks. Now, our compliance officer is actually one of the key advisors to FATF and is quite a big face in the compliance scene. And so, one of the long-term goals that we've given him is obviously to try and educate regulators towards the point where actually, do you need to be an accredited investor to be purchasing $10 of SpaceX? Like, probably not. So, but it's going to be a long time until we get there. So we have to work with the framework that we currently have, show ourselves to be credible participants, and then educate the regulators about how we move forward. And I think your question is very pertinent to that point.
Just in closing, I know this is about 2020. I think there's a real role for leadership, whether it's this council that Sandra runs or some of the players here. I mean, you were at Google, you could have stayed there as a big hero and you set up a group at MIT. I think it's time to kind of show leadership on helping frame this world.
Well, thank you very much, John, Jason, Michael, Neha, and Richard. Thank you so much. This conversation is going to continue, with all of you guys in the room. So appreciate you guys coming out.